at the start of COVID. Kelly? And this could be a big Fed meeting to find out whether they will actually sell mortgage-backed securities from their portfolio. Absolutely. And if we see that and we see mortgage rates moving even higher and affordability moving even lower, that just pulls more buyers out of the market. And we have seen home sales dropping for the past 5 months. The question then going forward is, what effect does that have on home prices? Generally, there's a 6-month lag between the two, but there's still so much demand out there. And as you said, so little supply. Absolutely. Diana, for now, thank you very much, Diana Olick. That does it for the exchange, everybody. Don't go anywhere. We are moments away from the Fed's decision on interest rates. I'll see you on the other side of this quick break when Power Lunch picks up our live coverage for a very important hour.
New projects means new project man.
Yeah, guys, they're about ready to come on here in about 8 minutes for the Feds, and we were just I was just watching this on CNBC, where when they started the pandemic, and for a home price for interest rate went up $1,800 from what you would be paying on a mortgage from crypto. I mean, I'm sorry, not crypto, from the pandemic of COVID. So if you got a mortgage 2 years ago and the same price of, just say it was a $300,000 house, where you're going to pay an extra $1,800 more just because of what's going on. And my point of view of that is, the Feds have been buying its own bonds for many years, which I think that's not good at all. And what our stock market has done over the last few years, just like in 2008, it was on a bubble. So I believe that we are sitting here buying into our own debt. For what reason? I mean, for our way of living, our standard of living and everything. And that's great for us, for Americans. But, what is it going to do in the long run for our kids and ourselves? Is that the best thing that we should be doing? Or is that for the banks and the businesses and stuff like that? These, people that have all the money. Who's it helping? Is it helping us or is it helping them? So I have a different opinion of probably than most people, but I always feel like that even when 2008 and 2009 was going on, with all the house prices that was skyrocketing and everything, that how are people affording it? And I make really good money, but I mean I don't own a house. I rent a house. So, but if I went out to buy a house now, and the housing market in the last 2 years has climbed as high as it has, I mean, it's outrageous. So, I just think it's been a bubble for a long time, and they keep on doing this, and they see that Americans just keep wanting and wanting and wanting, and they'll, everybody needs a house, and the government cannot manufacture houses. They're not good at businesses, where the public sector is a lot better than the government. So, I will have to say this about the audio and all that. It's going to be just a little bit delayed, anything. So a few seconds, but
You need to hire.
just give it a little bit. I just apologize for that. So, but here comes the Fed decision here in just a second, and moments away. So just give me a few seconds and it will be on right about now.
Some big moves here today. It is just a hair below 3% right now. 2.991.
And of course, that's a good benchmark. It looks like the markets are just waiting to see what happens. Our panel today, David Kelly, Chief Global Strategist at JP Morgan Asset Management, Mona Mahajan, Senior Investment Strategist at Edward Jones, and Jim Caron, Global Fixed Income Portfolio Manager at Morgan Stanley. We kind of know, don't we, David, what the Fed is likely to do, a half-point rise in interest rates. But the question to me is, what is the level of the Fed funds rate? How high does it have to go ultimately to tame inflation? Much higher than where it is.
It does need to rise. I do think the Federal Reserve will continue to increase it at a relatively rapid pace throughout this year, but they don't have to do the whole job themselves. I think that's absolutely key. This economy's got a lot of braking power in it anyway. And so if they push the federal funds rate up to, say, 2.5% by the end of this year, long rates rising, high dollar, less fiscal stimulus, this economy is going to slow anyway. Inflation is going to turn down anyway. So I think the key thing here is for the Federal Reserve, don't be too aggressive here. Make sure you protect the economy. Don't send it into recession. You don't need to do that because inflation will gradually ease anyway.
Quickly, what are, David, those slowing pressures that you cite? Is it the high dollar that is going to make our exports more even more expensive than they are today?
Sure, high dollar, huge fiscal drag because we've got a much smaller deficit this year, and then also we get a rebound from COVID in the second quarter, but then that's kind of done. And so I think the services rebound will fade as the year goes on. And that's a lot of things dragging the economy down, slowing the economy down. Mm-hmm. So the Federal Reserve doesn't need to do it all themselves. This economy is already losing momentum.
Mona, now we have to ask where the next stop is on the 10-year. We're already about kissing 3% again today.
Yeah, absolutely. Look, the 10-year's moved, it's a double this year. It started around 150. Now we're close to 3%. Do we think that rate of change annualizes? Do we keep going at this pace? Probably not. But could we get beyond 3%? We think 3.5% could be likely. Keep in mind, markets do tend to overshoot both on the upside and the downside. But the key really will be, to David's point, if and when we start to see inflation more meaningfully roll over, that's when we're going to see yields peak and more meaningfully roll over as well. So we think we're perhaps not quite there, but getting closer to a peak in yields as well.
Jim, if we want to get to 2% inflation, how high do interest rates need to go? And what's the risk of a recession implied by that?
So that's the absolute key question. And I think if the Fed is absolutely dead serious about getting inflation to target by 2024, which is the term of their forecast expectations, then I think the Fed funds rate needs to go, well above 3%. So it could be that they go to 3.25%, 3.5%. And the question I always ask, and it's the question that you're asking, Tyler, which is, what is the breaking point for the economy? Where do things really start to slow down? And I think they do once we get above 3%. And that's what we're seeing in equity markets. That's what we're seeing in other markets. Importantly, though, we're not really seeing it too much in the credit markets. Credit spreads are staying well contained at this point. So I think if I'm looking at this from the Fed's view, financial conditions might not be tight enough to control inflation. I agree with what David's saying. I think that plenty of things are going to slow down, but will it happen fast enough for the Fed's liking?
Financial conditions not tight enough, Jim?
I don't think so. Based on where I see credit spreads right now, credit spreads have been hanging in pretty nicely. And it's really a question of having a financial market feedback to slow inflation down within the time frame that the Fed wants those inflation pressures to come down. So that's in the next couple of years. So I would argue right now that, yes, equities have melted down and, for sure, and rates have gone up, but we're not really seeing enough of a slowdown, at least by my calculations, to get to 2% inflation within the time frame that the Fed is specifying without hiking more.
All right, Jim, it is like you knew what time it was because right now we're going to go to Steve Leisman for the news. Steve.
Yeah, the Federal Reserve, I can tell you. Federal Reserve raising the target range for the federal funds rate by 50 basis points to a new target range of 75 basis points to 1 percentage point. The Federal Reserve increasing, says ongoing increases will be appropriate. The Fed will begin to reduce the balance sheet on June 1. It will ramp up the balance sheet reduction over time. It's going to begin with $47.5 billion in balance sheet reduction through August. And then after that 3-month period, it's going to reduce the balance sheet to allow the runoff of $95 billion a month as expected. And that'll happen beginning in September. That'll be a total of $60 billion in treasuries running off the balance sheet every month, $35 billion in mortgages. The Federal Reserve says household and business spending remains strong. Job gains have been robust. The Russian invasion of Ukraine likely puts upward pressure on inflation and weighs on economic activity. A very quick analysis, guys. There's one sentence in here that was a little more dovish than I expected, and a lot of other observers thought there'd be a line in here about the Fed moving expeditiously towards neutral. It doesn't say that. It just says anticipates ongoing increases will be appropriate. Doesn't say how much. We're going to have to leave that for Fed Chair Jay Powell, and whether or not he'll put some character on the pace and amount of tightening to come from the Federal Reserve. But as expected, 50 basis points and balance sheet runoff ramping up to $95 billion a month. Kelly?
Steve, let's highlight two key things here as we're watching a knee-jerk dovish reaction to the statement. We see yields dropping about 5 basis points on the 10-year to 295 and equities moving higher somewhat. The Dow is up 250. It seems like you said they didn't use the word expeditious. Also, why are they doing half the expected pace of quantitative tightening for the first 3 months?
Oh, so no, we expected that. We actually began to survey that, Kelly, back several months ago in the Fed survey that the Federal Reserve would ramp up to the $95 billion. They've done that before. It was, I think, fairly well expected. I apologize for not mentioning it in the lead up to this, but they're going to do that for 3 months. They want the market to adjust to this. Then they'll get to $95 billion.
So you think this is, what do you think then, Steve, are the dovish surprises from the statement? No dissenters.
Just the one comment here. I saw a bunch of people, and because Powell went forward and said we're going to move expeditiously back to neutral, people thought that was going to be the new sort of buzz phrase that told us 50s were in and around or possibly coming for the statement. But that was not adopted in the actual language here. We'll see if Powell uses it again. Expeditiously to neutral, to put numbers around that, Kelly, the way people understood that is 50 basis point hikes to 2.25, 2.5. They didn't say that. I'm not going to go overboard here and say this is a dovish statement. Remember, the Fed raised by 50. Remember, the Fed is going to $95 billion a month in runoff. So don't lose sight of the trees here, or the forest here for the trees. I think the story here is whether or not the Fed is getting behind this idea of all of those 50s en route there, whether or not there's some play up and some play down here.
All right, let's stick around, Stephen. We're going to bring back our panel, plus Bob Pisani and Rick Santelli also joining us. Rick Santelli, let's turn to you. What are you seeing in the bond market?
You know, it's unbelievably trim and quiet considering. Now, it's a lot of price volatility and yields moving, but just consider, we were at 279. That's where the market was right before Steve Leisman started to read what the Fed was going to embark on. So basically, it's unchanged. And definitely some stochastic process going on there. 297 was where 10s were exactly before Steve started to read the statement. That's pretty much where they are now. The yield curve, 10s to 2s, was separated by about 19.5 basis points, exactly where it's at now. So what I think is the aggressive tendencies of the Fed have to be embedded in the marketplace because the Fed isn't going to back down. You know, they're basically putting a block on their shoulder and say, knock it off. Inflation, we're going to deal with you. We're going to squash inflation. So they have to have that unified front. But in reality, the market's pricing in my estimation, worst case scenarios that most likely aren't going to happen. Now, do I think the Fed isn't going to embark on a big tightening cycle? Of course I do. But I just think that going back to 2018 and 2019, perfect examples. In 2018, we had some tightening. Powell was tightening. And the markets, the same markets we're quoting now, we're showing 3 more tightenings in 2019 that turned into 3 eases. So I'm just saying that we need to slay inflation. You need to have a unified front of being tough. But you can't back down at all, even though deep inside, I do think the Fed understands that inflation, at least caused by supply chain issues, is going to moderate. The problem is there's lots of inflation that isn't, like labor inflation. Right now, we say, you're not getting paid as much as inflation's going up. But my guess is in 2 or 3 years, That's going to reverse a bit. We're going to see higher wages stay, and we're going to see some of the inflation levels actually dip below that. I think the Fed's doing as good a job as possible considering they waited too long.
All right, thanks very much, Rick Santelli. Let's go now for a look at the equity market to Bob Pisani. Stocks rather cheered, it would seem, Bob.
Cheered, but very muted. Same thing with the equity market as the bond market. We were moving actually before the Fed announcement, a couple minutes before, 4 to 186. And then right after that, we were moving up and moved to 42.10. We're right around the 4,200 level right now. So fairly muted reaction. I think the issue for everybody down here is, has the market priced in enough Fed hawkishness? We're talking about 3% Fed funds at the end of the year. Powell has implied he wants a soft landing. The stock market doesn't believe that he's going to be able to deliver on that. That's the big problem. So can you do a soft landing or not? And the problem is at the meeting, I think you're going to find out, or at the presser, you're going to find out he can't imply that they're not going to be even more aggressive. He can take 75 basis points off the table. And if he doesn't, that's going to imply an even harder landing. So it's hard to argue for a soft landing when the Fed isn't going to stop with the aggressiveness overall. I can tell you one thing. There is a very bullish opinion being pushed that inflation is peaking. That's going to cause the Fed to back off later in the year. Powell himself addressed this recently at the IMF panel. He said it may be the peak will be in March, but we don't know that, and so we can't count on it. So Powell himself has told the bulls, don't expect us to back off just because you see inflation peaking in March. And I think that's what's going to keep the markets on edge for a while.
All right, Mona, let's turn to you for some reaction and analysis here. Takeaways?
Yeah, absolutely. I think generally what Rick had mentioned is right. I think the markets have priced in a very aggressive Fed. What we may hear from them today is no explicit dovishness. It does not make sense for them to be dovish when inflation has not yet moved. But if they are asked about a 75 basis point rate hike or an intra-meeting rate hike, and they don't explicitly endorse it, the market may take that as, on the margin, a slightly dovish reaction as well. So I think they will put their foot on the pedal, but they may not explicitly endorse some of the most aggressive forms of tightening. And I think that's what we'll be watching for to see what their path is going forward and how the markets may react to it.
Jim Karen, same question to you. What were the big surprises for you here?
Well, I think that the Fed will likely continue to be very, very hawkish, but it seems that the initial statement wasn't overly hawkish. So I think the markets have taken a little bit of a reprieve from that. The one thing that I'll say, though, is that we have to respect the initial conditions. The market, the economy has been strong, and we're coming from a very, very strong footing. The equity markets, for example, have been very, very strong. Now, clearly they've weakened, but we're coming from a very, very strong place. So what it seems to me like is that the markets are still a bit unafraid of the Fed. Now, the only issue that I have with that is that if the Fed wants to use their financial conditions to contain inflation risk, which is what they can do, that's what their policy is designed to do, then I would argue that the markets probably have to go through a little bit more pain before the Fed actually achieves its goal of pushing inflation to the levels that it wants to, and that they're confident that will actually get to that target inflation point. And I don't see that quite yet, so I'm still a little bit nervous about the markets going forward. Today, right now, might be okay, but going down the road, I'm a little bit concerned.
David, why don't you react to what Jim just said? Are the markets insufficiently afraid of the Fed? I think that was one of the takeaways I took there.
No, and I think the markets are probably getting this about right. I think the Fed is fundamentally dovish by its nature. They've been squawking like hawks over the last year because inflation's been high. But the reality is, as the economy moves forward to the end of this year into next year, it's going to slow, inflation's going to roll over, and the Fed doesn't want to make the typical mistake of waiting too long and then doing too much and putting the economy into recession. And I think that, Jay Powell at this press conference is going to be asked a lot of questions along the lines of, are you afraid of tipping the economy into recession? I think he's got to reassure people both that we're pretty confident inflation will come down, and no, we're not going to overdo this and put this economy into recession. I think that will be comforting to markets.
Steve, let me turn back to you, and we've talked a good bit about the interest rate question. Let's talk about the balance sheet and the pace at which it may decline. $9 trillion right now. It's going to start at about $47 billion a month, if I'm reading right, between treasuries and mortgage backs, and rise to $95 billion. Why didn't the Fed go there sooner? That was a way to get into this tightening a little quicker?
Why didn't it go to 95 billion?
Well, no.
Quickly,
Why
is that
didn't
your
it
question,
begin?
Tyler?
Why didn't it begin squeezing the balance sheet sooner? That's number one. And what do you make of the pace that it is embarking on now?
So I think that the Fed not going sooner is one of the biggest mistakes the Fed has made, maybe since I've been covering them. I mean, they all sort of felt like they should have stopped buying assets. They were doing so, Tyler, incredibly through March, a time which was the same month that they reversed course. They had a plan to do something, and they wanted to be, I guess the only excuse you could give is they wanted to follow through with their plan to do something through March. They did so, and then they reversed course almost automatically. It's part of the reason they have to be a little more firm now in terms of raising rates, probably why they're doing 50s now. They probably should have stopped. Powell made a pivot a little bit late, not crazy late in November. You could argue maybe he should have done it in September, but you could say he still had a COVID crisis to deal with back. If you remember, there was another outbreak. Okay, so he was a little late in the rhetorical pivot, but he was much too late in terms of the pivot when it came to buying or stopping the purchase of assets in QE. Let me just say real quickly, Tyler, when all is said and done, I hate to do something too quickly after a statement comes out. We're now, 11 minutes after liftoff here, and I see very little change here in the Fed funds futures market outlook. I'm still seeing them price in 450 basis point rate hikes through September, which means you get to that sort of nebulous neutral rate of 2.25, 2.5 by the September meeting. There's maybe something less of a chance of a 75 basis point rate hike built in, maybe a little bit that came off the boil, but not entirely. It's still 35% for June or July. So I happen to think that this is exactly what Powell wanted. He set the market up for this report or these actions. He gave it to them, and the market at the moment seems to be kind of even and flat on getting exactly what Powell told us we were going to get.
On that note, Rick Santelli, a final thought from you here. The 10-year, which initially dropped about 5 basis points on the statement, is a little bit higher again. I mean, 297, 298, that range. What are you watching?
I am watching the 2s to 10 spread. It's just the easiest way to kind of handicap what's going on the shorter maturities that have been more aggressive in their rate increases because they're more closely tied to the Fed overnight rate. And the long end, of course, has a variety of issues. Investors like to buy higher yielding instruments, even if they're not necessarily in positive real rate territory. And, of course, we have this notion that the long end is going to be our canary in the coal mine, so to speak, on whether the recession, which is caused by inflation and bad policies and mistakes, not by raising rates, which is actually the medicine. And I think that by watching that, if we get around zero, that's not going to be a very good thing. And if we see a bit of steepening, I think that would be a better thing.
All right. There's the 2s-10 spread, just under 20 basis points. And big thanks to our panel, everybody. We really appreciate your thoughts, your reaction, your analysis this hour. Mona, Jim, Rick, Bob, and David Kelly, and of course, our Steve Leisman. You don't see him in the picture there because he's going over to ask some questions to Jay Powell at 2:30 when the press conference starts. Coming up here, we have more analysis and reaction to the decision from a former governor who's been critical of the central bank, plus Ed Yardeni on the potential still for a soft landing for markets and the economy. We're just moments away from this market-moving press conference with Fed Chair Jay Powell. Keep it right here.
Let's go where lives are changing and the world is going online.
Well, yeah, it's definitely going up. So as everybody knew, All right, sorry about that. I didn't know that. I honestly forgot to put the thing back onto my other screen. So apologize. Thank you for letting me know that. And the question is from Josh is my question is how fast can the Feds decrease inflation without sparking a recession? I think there's no matter what we're not going to be able to stop the recession. It's going to happen. I think they try to do quite a bit with COVID and all that. So when COVID hit 2 years ago, that's when everything dropped down to even, the interest rate down to almost zero to borrowing money from. So I don't think they can. I don't think they can stop the recession. I don't think history has shown anything different than that. So, in my opinion, it just, untreaded waters we've been into with COVID and with everything that's going on with COVID, with supply and demand. We got so much demand and very little supply, and we got China, doing another lockdown and all that. So I'll let you go back to hearing this, Josh. Hold on a second, buddy.
The Fed fund rate needs to be positive, i.e. above the inflation rate, which would put it at something like 7 or 8%. That would spell recession or maybe even worse, wouldn't it?
Well, both boom times as well as recession times can cause high interest rates. If we're in a big boom, if we have a lot of inflation, interest rates will be high. But at the present time, the Federal Reserve has to step on the brakes and actually slow down the economy. And therefore, we got to have positive real rates. And that means a much, much higher Fed funds rate than we have at the present time.
So you would have liked to have seen them raised by how much today? A point? 2 points? What?
Yeah, the more the better. They should have raised a long time ago. Now they're behind the curve and they're in a box. They have to raise it very high. They are talking about 50 basis point steps, but that will not stop inflation for a long time to come.
So, Ed, I don't know whether you agree with Robert or you disagree, but I do know in my notes that you say a lot of people are asking you, so why not just do it? Get it, go more aggressively sooner and take the rate to where you think you're going to be able to effectively slow inflation and do it fast.
Right. Well, to your first question, I am in a opposite camp. I think that 2.5% to 3% of the Fed funds rate is going to slow the economy down enough to help bring inflation down. Inflation isn't totally a monetary phenomenon. That's something we've learned over the past 10 plus years. The Fed is, remember when the Fed tried to bring inflation up to 2% with very easy money and couldn't do it? There are other factors at work operating on inflation. And I think the supply chain disruptions is certainly an issue which will get increasingly resolved. We've really had a tremendous inflation led by consumer durable goods, used car prices, new car prices, appliances, bedding. I mean, these things that just don't keep going up at 15 to 20%, which is what we've been seeing over the past couple of years. I think they are going to start simmering down. I think we had a demand shock that was stimulated by way too much fiscal and monetary easing. And now I think we're going to see that the demand for goods is satiated to a large extent. Pent-up demand is satiated. We're going to see some strength in services. So I think the Fed is actually going to accomplish a soft landing. I'm not in the recession camp.
And I wonder, though, if this doesn't capture the potential for higher services inflation that's coming. It almost feels like we're going to be in a Twin Peaks situation where we had the good spike, and that was one thing. But how do you get rid once it's embedded? I mean, look at HCA's results the other day. Health services inflation. Look at what everyone from Tupperware to Lyft has said in the past 24 hours about wage inflation.
Sure. Yeah, I think you're making a very good point, a very important point. I think on the services side, the main trouble is going to be on rent. As we know, rent inflation right now is quite elevated. New leases, by some accounts, nationally are up 12 to 15% on a year-over-year basis. With a lag of about 12 to 18 months, all those new leases get into the pool of leases, and we'll see that in the CPI. My forecast is that the consumption deflator inflation rate will probably peak within the next few months at 6 to 7%, and then I think it's going to come down to to something like 4 to 5% by the second half of the year. So I think we will see a peak. It's still going to be high. And then next year, I think we'll get down to 3 to 4%. And the year after that, 2023, I think we could actually get down to 2%. I think what the markets want to see and what the Fed wants to see is some credible evidence that we're peaking. We're not going to go back to 2% anytime soon. I think that's pretty obvious to everybody.
I'm going to ask the esteemed Mr. Heller to respond to the esteemed Mr. Yardeni, who seems to feel like 2.5% on the Fed's fund rate is going to do the job in slowing the economy and slowing inflation. You disagree. You think those rates need to be 3 times as high.
I totally disagree. As you keep pouring more liquidity into the bathtub, the water level rises, and that will lift all prices of all the commodities, of all the ships afloat. Inflation will continue to increase. You got to get the money supply much, much lower. At the present time, it's growing at over 10% after having grown 25% in 2020 and 21. So there's tons of liquidity, and we see that liquidity working its way through. I'm an old man. I've been there in the 70s and in the early 80s, and it will not end pretty.
Ed, yeah, go ahead. Yep. And also inject some advice for investors here, because from what you're saying, it sounds like they can just kind of relax and, all will be well.
Well, and all will not necessarily be well, but I think there's way too much pessimism out there. And I think there are lots of analogies between the inflation now and the 1970s. But one of the huge differences is productivity collapsed during the 1970s. This time around, I think we're going to see productivity really pick up. Productivity growth actually bottomed on a cyclical basis back in 2015 at 0.5%. It's already up to 2%. I think it's heading up to 4.5%, which is what we've seen in previous productivity cycle booms. The reason for that is there's a shortage of labor, and companies, I think, increasingly are going to scramble to increase the productivity of labor. In terms of investing, I think it's too late to panic. I certainly wouldn't be selling here. Probably made a lot more sense at the beginning of the year if you saw all these things coming. But look, it's very hard to call corrections. And I think this is still a correction. You have to call both the top and the bottom. And right now, a lot of people who might have taken some credit for calling the top, I think are going to miss the bottom.
I want to get a quick final thought from Mr. Heller, if I might. One of the things that worries me is that I'm not sure we've seen the top inflation in such things as fertilizer, wheat, corn, and natural gas because of the war in Ukraine. What say you?
I fully agree with you. Those are contributing factors, but the essential factor is the excessive monetary expansion. And the Federal Reserve never talks about money. What's monetary policy without looking at money? That's my question.
All right, Mr. Heller, thank you very much. Ed Yardeni, great to see you, sir. Always a pleasure.
I can't keep up with these markets, by the way. Just a moment ago, the S&P and NASDAQ had turned negative. Now the S&P is back positive. The Dow's up 100 points, where it looked for a second like it might go lower. It tells you just how jumpy we are ahead of hearing from Fed Chair Jay Powell. His press conference begins in just about 5 minutes' time. We'll bring it to you with some last-minute analysis and setup next.
Look, this isn't my first rodeo.
Well, both guys' comments was real good. I mean, I like the first guy. You got to get the inflation in check. You got to raise the rates. And why are they not raising the rates quick? I mean, what do I not know about that? I mean, we're going to have big time troubles. I mean, have we done it in the past? I mean, give us examples why it hasn't worked in the past and why we're not doing it right now. So, are you trying to gain back? I feel like, are you trying to gain back all the lost money that you gave away? I mean, everybody's made money off of that. I mean, but even the Fed's buying up their own bonds. That's the whole problem of I mean, why would you buy back your own bonds that you're putting out there? So I know there's got to be something why they're doing that, and I know it's to keep the economy up to, the stock markets and all that, but here the banks are, J.P. Morgan, Bank of America, Goldman Sachs, they're getting all this, this money, and off of what? Off our backs, off of the small people's backs. Because regardless, the New York Stock Exchange companies have had record quarterly growth in the billions of dollars despite the situation. You're correct, Josh. Big time correct. I mean, that's all they do. Here we are, like I said earlier, I'm not sure if you were on here. 2 years ago, for a mortgage of $300,000, and now 2 years later, that same mortgage you're going to pay $1,800 more. So, and eventually it's going to come down to, where the interest rates will come down and people refinance. Well, what's that do? So the person that's working at the bank, or the lender, or they're going to repeat this cycle, and that's why they want people to refinance and anything, because that, what I have found out over the years, they push things for a few years, and then where you have to go back and refinance because it makes everybody else more money. So that debt was on the books for a while, gets taken off and gets paid off, and then turn around, you get new debt back on there, and it's a vicious cycle in a lot of ways,
Set up for that shows they're all back in positive territory. We've had some pretty big moves here. Just 2 minutes ago, the Dow was up 40 points. Now it's up 270. So these are session highs. The S&P up 27, the NASDAQ up 24.
There is a lot of trading going on. I bet a heck of a lot of it is algorithmic trading, probably machine-oriented trading. As you see there, the spread between the 2-year and the 10-year, about 20 basis points or thereabouts. Let's go to Bob Pisani as we wrap up this abbreviated edition of Power Lunch before we hear from the chair. Talk to us, Bob.
Tyler, we're just about where we started, maybe 10 points higher in the S&P. There's two problems for the markets right now. First, it wants to be convinced that Powell can engineer a soft landing, but it doesn't really believe it because it knows that Powell has to maintain the inflation-fighting credibility, and so leave the possibility even more aggressive rate hikes are on the table. That's going to keep people on edge. The second problem is the Fed is not going to be deterred by this argument that inflation might be peaking in March and April. Powell said earlier at various roundtables, we don't know if inflation is going to be peaking right now, and we cannot count on that. And because of that, you're going to see people who are going to be out there arguing, well, the inflation's peaking, therefore the Fed's going to back off. Powell has already said we can't do that. We can't rely on that. We have to make sure that we're fighting inflation. So the Fed's credibility is really at stake here, and that's why I think he's not going to take more aggressive rate hikes off the table at the 2:30 meeting. And that's going to be the first question anybody is going to be asking him. Guys?
Remarkable to see stocks breaking out really towards session highs. We should check on the financials, some of the other key sectors as well. Give us a little bit of that flavor. Dow up 240, S&P up 24, NASDAQ, which had been the big laggard today, up 15. And there the financials are up about 0.75%.
All right, we're waiting for Fed Chair Powell to approach the podium down in Washington. This, I think, is going to be a live press conference for the first time in a very long time. Our Steve Leisman is in the audience, in the room down there, and as we get ready to see what he says, and there is the room. And there, I can tell you, that is Steve Leisman's head right there. And there is the chair.
Good afternoon. It's nice to see everyone in person for the first time in a couple of years. Before I go into the details of today's meeting, I'd like to take this opportunity to speak directly to the American people. Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.5 percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. After expanding at a robust 5.5% pace last year, overall economic activity edged down in the first quarter. Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports, two volatile categories whose movements last quarter likely carry little signal for future growth. Indeed, household spending and business fixed investment continued to expand briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months of the year, employment rose by nearly 1.7 million jobs. In March, the unemployment rate hit a post-pandemic and near 5-decade low of 3.6%. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. Employers are having difficulties filling job openings, and wages are rising at the fastest pace in many years. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 5.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. Disruptions to supply have been larger and longer lasting than anticipated, and price pressures have spread to a broader range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to further exacerbate supply chain disruptions as well. Russia's invasion of Ukraine is causing tremendous loss and hardship, and our thoughts and sympathies are with the people of Ukraine. Our job is to consider the implications for the U.S. economy, which remain highly uncertain. In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, creating spillovers to the U.S. economy through trade and other channels. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.5 percentage point and stated that it anticipates that ongoing increases in the target range will be appropriate. We also decided to begin the process of reducing the size of our balance sheet, which will play an important role in firming the stance of monetary policy. We are on a path to move our policy rate expeditiously to more normal levels, assuming that economic and financial conditions evolve in line with expectations. There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings. We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy. And we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal. With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than the monthly cap, Treasury bills. For agency mortgage-backed securities, the cap will be $17.5 billion per month for 3 months and will then increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires the recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Nick Generoso, the Wall Street Journal. Chair Powell, the unemployment rate at 3.6% in March is now essentially at the level that the committee had expected would prevail over the next 3 years, and at the bottom end of FOMC participants' projections for the longer run rate that you submitted in the projections at the last meeting. How has your outlook for further declines in the unemployment rate changed since March? What does this imply for your inflation forecast? And how has your level of confidence changed with regard to the feasibility of slowing hiring without pushing the economy into recession? Thanks.
Thank you. So you're right. 3.6% unemployment is just about as low as it's been in 50 years. And I would say that I expect, and committee members generally expect, that we'll get some additional participation. So people will be coming back into the labor force. We've seen that, particularly among prime age people. And that will, of course, tend to hold the unemployment rate up a little bit. I would also expect, though, that job creation will slow. Job creation has been at more than 500,000 per month in recent months, very, very strong, particularly for this stage of the economy. And so we think with fiscal policy less supportive, with monetary policy less supportive, we think that job creation will slow as well. So it is certainly possible that the unemployment would go down further. So I would expect those to be relatively limited because of the additional supply and also just the slowing in job creation. Implications for inflation, really the wages matter a fair amount for companies, particularly in the service sector. Wages are running high, the highest they've run in quite some time, and they are one good example of, or good illustration, really, of how tight the labor market really is. The fact that wages are running at the highest level in many decades. And that's because of an imbalance between supply and demand in the labor market. So we think through our policies, through further healing in the labor market, higher rates, for example, of vacancy filling and things like that, and more people coming back in, we like to think that supply and demand will come back into balance and that therefore wage inflation will moderate to still high levels of wage increases, but ones that are more consistent with 2% inflation. That's our expectation. Your third question was
Your level of confidence that you can slow hiring without pushing the economy into a downturn.
So I guess I would say it this way. There's a path. there's a path by which we would be able to have demand moderate in the labor market and therefore have vacancies come down without unemployment going up, because vacancies are at such an extraordinarily high level. They're 1.9 vacancies for every unemployed person, 11.5 million vacancies, 6 million unemployed people. So, and we haven't been in that place on the vacancy, sort of the vacancy unemployed curve, the beverage curve. We haven't been at that sort of level of a ratio in the modern era. So in principle, it seems as though by moderating demand, we could see vacancies come down, and as a result, and they could come down fairly significantly, and I think put supply and demand at least closer together than they are, and that would give us a chance to have get inflation down, get wages down, and then get inflation down without having to slow the economy and have a recession and have unemployment rise materially. So there's a path to that. Now, I would say I think we have a good chance to have a soft or softish landing or outcome, if you will. And I'll give you a couple of reasons for that. One is households and businesses are in very strong financial shape. You're looking at excess savings on balance sheets, excess in the sense that they're substantially larger than the prior trend. Businesses are in good financial shape. The labor market is, as I mentioned, very, very strong. And so it doesn't seem to be anywhere close to a downturn. Therefore, the economy is strong and is well positioned to handle tighter monetary policy. So, but I'll say I do expect that this will be very challenging. It's not going to be easy, and it may well depend, of course, on events that are not under our control. But our job is to use our tools to try to achieve that outcome, and that's what we're going to do.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You talked about using 50 basis point rate hikes or the possibility of them in coming meetings. Might there be something larger than 50? Is 75 or a percentage point possible? And perhaps you could walk us through your calibration. Why 1 month one meeting should we expect at 50? Why something bigger? Why something smaller? What is the reasoning for the level of the amount of tightening? Thank you.
Sure. So 75 basis point in an increase is not something the committee is actively considering. What we are doing is we raised 50 basis points today, and we've said that, again, assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings. So we're going to make those decisions at the meetings, of course, and we'll be paying close attention to the incoming data and the evolving outlook, as well as to financial conditions. And finally, of course, we will be communicating to the public about what our expectations will be as they evolve. So the test is really just, as I laid it out, economic and financial conditions evolving broadly in line with expectations. And, I think expectations are that we'll start to see inflation, flattening out and not necessarily declining yet, but we'll see more evidence. We've seen some evidence that the core PCE inflation is perhaps either reaching a peak or flattening out. We'll want to know more than just some evidence. We'll want to really feel like we're making some progress there. But I mean, we're going to make these decisions, and there'll be a lot more information. I just think we want to see that information as we get there. It's a very difficult environment to try to give forward guidance 60, 90 days in advance. There are just so many things that can happen in the economy and around the world. So, we're leaving ourselves room to look at the data and make a decision as we get there.
I'm sorry, but if inflation is lower 1 month and the unemployment rate higher, would that be something that we would calibrate towards a lower increase in the funds rate? Or
I don't think 1 month is not no 1 month's reading doesn't tell us much. We'd want to see evidence that inflation is moving in a direction that gives us more comfort. As I said, we've got 2 months now where core inflation is a little lower, but we're not looking at that as a reason to take some comfort. I think we need to really see that our expectation is being fulfilled, that inflation, in fact, is under control and starting to come down. But it's not like we would stop. We would just go back to 25 basis point increases. It'll be a judgment call when these meetings arrive. But our expectation is If we see what we expect to see, then we would have 50 basis point increases on the table at the next two meetings.
Okay, so let's go to Colby.
Thank you. Colby Smith from the Financial Times. Given the expectation that inflation will remain well above the Fed's target at year end, what constitutes a neutral policy setting in terms of the Fed funds rate? And to what extent is it appropriate for policy to move beyond that level at some point this year?
So, neutral. When we talk about the neutral rate, we're really talking about the rate that neither pushes economic activity higher nor slows it down. So it's a concept, really. It's not something we can identify with any precision. So we estimate it within broad bands of uncertainty. And the current estimates on the committee are sort of 2 to 3%. And also, that's a longer run estimate. That's an estimate for an economy that's at full employment and 2% inflation. So really what we're doing is we're raising rates expeditiously to what we see as the broad range of plausible levels of neutral. But we know that there's not a bright line drawn on the road that tells us when we get there. So we're going to be looking at financial conditions, right? Our policy affects financial conditions, and financial conditions affect the economy. So we're going to be looking at the effect of our policy moves on financial conditions. Are they tightening appropriately? And then we're going to be looking at the effects on the economy. And we're going to be making a judgment about whether we've done enough to get us on a path to restore price stability. It's that. So if that path happens to involve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. But again, there's a sort of false precision in the discussion that we as policymakers don't really feel. You know, it's you're going to raise rates and you're going to be kind of inquiring how that is affecting the economy through financial conditions. And of course, if higher rates are required, then we won't hesitate to deliver them.
Neil.
Thanks, Chair Powell. Neil Irwin with Axios. Do you see evidence that inflationary psychology is changing, that in areas like workers' wage demands, businesses' willingness to raise prices, do you see evidence that there is a psychological shift going on inflation? Thanks.
We don't really see strong evidence of that yet, but that does not in any way make us comfortable. I think if you look at short-term inflation expectations, they're quite elevated. And you can look at that and say, well, that's because people expect inflation to come down. And in fact, inflation expectations come down fairly sharply. Longer-term inflation expectations have been reasonably stable, but have moved up but only to levels where they were in 2014 by some measures. So you can look at that, and I think that's a fair description of the picture. But it's really about the risks. We don't see a wage price spiral. We see that companies have the ability to raise prices, and they're doing that, but there have been price shocks. So I just think it takes you back to the basic point was that we know we need to expeditiously move our policy rate up to ranges of more normal, neutral levels, and we need to look around and keep going if we don't see that financial conditions have tightened adequately or that the economy is behaving in ways that suggest that we're not where we need to be. So again, you don't see those things yet, but I would say there's no basis for feeling comfortable about that. It's a risk that we simply can't run that risk. We can't allow a wage price spiral to happen, and we can't allow inflation expectations to become unanchored. It's just something that we can't allow to happen, and so we'll look at it that way.
Gina.
Great. Thanks, Chair Powell. Gina Smilik with the New York Times. You mentioned in the statement both the upside risks to inflation from Russia and China. Obviously, those are very much supply shocks rather than demand side. And I wonder what you meant to convey by adding them. I wonder what you meant to convey by adding those.
Well, so our tools don't really work on supply shocks. Our tools work on demand. And to the extent we can't affect really oil prices or other commodity prices or food prices and things like that. So we can't affect those. But there's a job to do on demand. And that you can see that in the labor market where demand is substantially in excess of supply of workers. And you can see it in the product markets as well. But I guess I'm just pointing out that a couple of things. for both the situation in Ukraine and the situation in China, they're likely to both add to headline inflation, and people are going to be suffering from that. You know, people almost suffer more from food and energy shocks but even though they don't actually tell us much about the future path. So, but the second thing is that they're both capable of preventing further progress in supply chains healing, and so, or even making supply chains temporarily worse. So they're going to weigh on the process of global supply chain healing, which is going to affect broader inflation too. So in a way, there are two further negative shocks that have hit really in the last, 60 days, 90 days.
Victoria.
Hi, Victoria Guida from Politico. I want to follow up on that because you all have obviously highlighted that there are both supply and demand issues at play in inflation. And I'm just wondering, if these supply chain issues continue because of Russia, because of China, or just because these things take a while to work out, does getting back down to your 2% mandate require that these supply chain issues get resolved, since you can only handle the demand side, as you said, or will you have to crimp demand maybe even further if the supply chain issues don't resolve themselves in order to try and get inflation back down to where you want it to be?
So, I'll just say for now, we're focused on doing the job we need to do on demand, and there's plenty to be done there. Again, if you look at it, it's essentially almost 2-to-1 job vacancies to unemployed people. There's a lot of excess demand. There are more than 5 million more employed plus job openings than there are the size of the labor force. So there's an imbalance there that we have to do our work on. It's a very difficult situation if you can't, you would look at core inflation, which wouldn't include the commodity price shocks, and that's one of the reasons we would tend to focus on that, because we can have more of an effect on that. But it would be a very difficult situation. I mean, we have to be sure that inflation expectations remain anchored, and that's part of our job too. So we'd be watching that carefully, and it puts any central bank in a very difficult situation.
Howard Schneider with Reuters, and thanks, and nice to be back. So two questions, one quick one. You cited the 1.9 to 1 figure so often now. I got to ask you, what would be a good figure there? What would you like to see that come down to think that you're at sort of a non-inflationary vacancy to unemployed rate? And secondly, on help from inflation, how much are you counting on wealth effects through stock market channels? Equity markets broadly down quite a bit since late fall, first of the year. How are you mapping that into household consumption? Have they come down enough? Do you need another leg down in equity values to think that households are going to stop spending at the rate you need them to stop spending?
Okay, so in terms of the vacancies to unemployment ratio, we don't have a goal in mind. There's no specific number that we're saying we've got to get to that. It's really, you've got to get to a place where the labor market appears to be more in balance. And that depends not only on the level of those things, it depends on how well the matching function in the labor markets are working. Because the longer these expansions go on, you can get very efficient with all of that, and the beverage curve shifts out, and that also tends to help. So there isn't a specific number. I will say we were at, I think when we got to 1-to-1 in the late teens, we thought that was a pretty good number. But again, we're not shooting for any particular number. What we'd like to see is progress, but we're not really looking at that. That's an intermediate variable. We're looking at wages, and we're looking at ultimately inflation. So there are a bunch of channels through which policy works. You can think of it as, interest-sensitive spending. And then you can think of another big one as asset values broadly. And, there are big models with a lot of different channels that are related to that. We don't focus on any one market, the equity market or the housing market, or we focus on financial conditions broadly. So we wouldn't be targeting any one market, as you suggest, for going up or down, or taking a view on whether it's at a good level or a bad level. We just would be looking at very broad measures of financial conditions, all the different financial conditions indexes, for example, which include equity, but they also include debt and many other things, credit spreads, things like that too.
Rachel.
Hi, Chair Powell. Rachel Siegel here from the Washington Post. To follow up from your message from the very beginning, what is your message to the American people about when they will start to feel the effects of, say, a 50 basis point rate hikes or multiple hikes? How do you explain to them what that does to their grocery bill or their rent or their gas bill? Thank you.
So, the first thing to say is that we understand, and some of us are old enough to have lived through high inflation, and many aren't. But it's very unpleasant. It's just something people don't, when they experience it for the first time. You're paying more for the same thing. If you're a normal economic person, then you're probably don't have that much extra, to spend, and it's immediately hitting your spending on groceries, on gasoline, on energy, and things like that. So we understand the pain involved. So how do you get out of that? And it's our job to make sure that inflation of that unpleasant high nature doesn't get entrenched in the economy. That's what we're here for. One of the main things we're here for, perhaps the most fundamental thing we're here for. And the way we do that is we try to get supply and demand back in sync with each other, back in balance, so that the economy is under less stress and inflation will go down. Now, the process of getting there involves higher rates, so higher mortgage rates, higher borrowing rates, and things like that. So it's not going to be pleasant either. But in the end, everyone is better off. Everyone, particularly people on fixed incomes and at the lower part of the income distribution, are better off with stable prices. And so we need to do everything we can to restore stable prices. We'll do it as quickly and effectively as we can. We think we have a good chance to do it without a significant increase in unemployment or really sharp slowdown. But ultimately, we think about the medium and longer term, and everyone will be better off if we can get this job done. The sooner, the better.
Thank you, Edward.
Thank you, Chair Powell. Edward Lawrence with the Fox Business Network. So you've talked in the past about consumer spending and how that's drives the economy. Are you concerned with this high level of inflation that the consumer will stop spending, pushing us into, and what's the level of your concern, pushing us into a recession?
So the economy is it's doing fairly well. We expect growth to be solid this year, and we see household spending and business investment as fairly strong, even in the first quarter, which was relatively slow on some other fronts. So, and the labor market. You look at the labor market for people who are out of work and looking. There are lots of job opportunities. For wages are moving up at rates that haven't been seen in quite a long time. So it's a good time to be a worker looking to either change jobs or get a wage increase in your current job. So it's a strong economy, and nothing about it suggests that it's close to or vulnerable to a recession. Now, of course, given events around the world and fading fiscal policy effects and higher rates, you could see some slower economic activity. Certainly, it will not be. Last year was an extraordinarily strong growth year as we recovered from the pandemic. As I mentioned, growth over 5%. But most forecasters have growth this year at a solid pace, above 2%.
But we've talked with economists who have advised Democrats and Republican presidents who both said that that the Fed is so far behind the curve on inflation that a recession is inevitable.
So, and as I said, I think we have a good chance to restore price stability without a recession, without a severe downturn, and without materially higher unemployment. And I mentioned the reasons for that. So I see a strong economy now. I see a very strong labor market, for example. Businesses can't find the people to hire. They can't find them. So typically in a recession, you would have unemployment. Now you have surplus demand. So there should be room, in principle, to reduce that surplus demand without putting people out of work. The issue will come that we don't have precision surgical tools. We have essentially interest rates, the balance sheet, and forward guidance, and they're famously blunt tools. They're not capable of surgical precision. So I would agree. No one thinks this will be easy. No one thinks it's straightforward. but there's certainly a plausible path to this, and I do think we've got a good chance to do that. And our job is not to rate the chances; it is to try to achieve it. So that's what we're doing. There are a range of opinions, though, and that's only appropriate.
Steve Dorsey.
Thanks, Steve Dorsey, CBS. You mentioned earlier just now fading fiscal policy. Do you feel that the Fed has been supported enough from policies at the White House and in Congress in combating inflation?
It's really the Fed that has responsibility for price stability, and we take whatever arrives at the Fed in terms of fiscal activity. We take it as a given, and we don't evaluate it. We don't. It's not our job, really. We don't have an oversight function there. And we look at it as our job to, given all the factors that are happening, to try to sustain maximum employment and price stability. So if the Congress or the administration has ways to help with inflation, I would encourage that, but I'm not going to get into making recommendations or anything like that. It's really not our role. We need to stay in our lane and do our job. When we get inflation back under control, then maybe I can, give other people advice. Right now, we need to focus on doing our job, and I'll stick to that. Stick in our lane.
Steve Matthews.
Steve Matthews with Bloomberg News. A number of your colleagues have said that rates will need to go above neutral into a restrictive territory to bring down inflation. One, do you agree with that? And two, you recently spoke in great praise of Paul Volcker, who had the courage to bring inflation down with recessions in the 1980s. And while it's certainly not your desire, and the soft landing is the big hope of everyone, would this FOMC have the courage to endure recessions to bring inflation down if that were the only way necessary?
So I think it's certainly possible that we'll need to move policy to levels that we see as restrictive as opposed to just neutral. We can't know that today. That decision's not in front of us today. If we do conclude that we need to do that, then we won't hesitate to do it. I'll say again, there's no bright line, that you're stepping over. You're really looking at what our policy stance is and what the market is forecasting for it. You're looking at financial conditions and how that's affecting the economy and making a judgment. We won't be arguing about whose model of the neutral rate is better than the other one. It's much more about a practical application of our policy tools. And we're absolutely prepared to do that. It wouldn't hesitate if that's what is taken. So I am, of course, who isn't an admirer of Paul Volcker? I shouldn't be singled out in this respect, but I knew him just a little bit and have tremendous admiration for him. And I would phrase it this way. He had the courage to do what he thought was the right thing. That's what it was. It wasn't a particular thing. It was that he always did what he thought was the right thing. If you read his last autobiography, that really comes through. So that's the test. It isn't will we do one particular thing. I would say we see restoring price stability as absolutely essential for the country in coming years. Without price stability, the economy doesn't work for anybody, really. And so it's really essential, particularly for the labor market. If you think about it, if you look at the last cycle, we had a very, very longest expansion cycle in our recorded history. And in the last 2-3 years, you had the benefits of this tight labor market going to people in the lower quartiles. And it was, racial wealth and income, not wealth, but income gaps were coming down, wage gaps. So it's a really great thing. We'd all love to get back to that place. But to get back to anything like that place, you need price stability. So we've been hit by historically large inflationary shocks since the pandemic. This isn't anything like regular business. We have a pandemic. We have the highest unemployment, since the Depression. Then we have this outsized response from fiscal policy and monetary policy. Then we have inflation. Then we have a war in Ukraine, which is cutting the commodity, patch in half. And now we have these shutdowns in China. So it's been a series of inflationary shocks that are really different from anything people have seen in 40 years. So we have to look through that and look at the economy that's coming out the other side and we need to somehow find price stability out of this. And it's obviously going to be very challenging, I think, because you do have, numerous supply shocks, which are famously difficult to deal with. So I guess that's how I think about it.
Hey, Chris.
Thank you. Chris Rugaber and Associated Press. Earlier, you just said that if necessary, I think were the words that you would, or if it turned out to be necessary, or you said it's possible that we'll need to move policy to restrictive levels. Given where inflation is and the hot economy is, or certainly the hot labor market as you described it, why still the hesitation? I mean, shouldn't it be, what else do you need to see in order to determine that? Wouldn't the Fed naturally be looking to go to a restrictive level at this point? Thank you.
So if I said necessary, I meant to say appropriate. We're not going to be erecting a high barrier for this. It's more if we think it's appropriate. The point is we're a very long way from neutral now. We're moving there expeditiously, and we'll continue to do so. And we can't make that decision really today. The decision about how high to go will be on the table to be made when we reach neutral. And, I expect we'll get there expeditiously, as I've mentioned. So it's not that we don't want to making that decision today wouldn't really mean anything. But I'll say again, if we do believe that it's appropriate to go to those levels, we won't hesitate.
Mike McKee from Bloomberg Television and Radio. The balance sheet, why did you decide to wait until June 1st to begin letting securities roll off and not immediately start in the middle of this month, say? And do you have a newer or a better estimate for the monetary policy impact of letting the balance sheet decline? And then finally, I'm just curious why you felt the need to address the American people at the top of your remarks. Are you concerned about Fed credibility with the American people?
So why June 1? It was just pick a date, and that happened to be the date that we picked. It was nothing magic about it. It's not going to have any macroeconomic significance over time. We just picked that. Sometimes we publish these calendars on the first day of the month, and that's what we're doing. I wouldn't read anything into it. In terms of the effect, I would just stress how uncertain the effect is of shrinking the balance sheet. We run these models, and everyone does in this field, and make estimates of what will be the how do you measure, a certain quantum of balance sheet shrinkage compared to quantitative easing. And, these are very uncertain. I really can't be any clearer. There won't be any clearer. People estimate that broadly on the path we're on, and this will be taken probably too seriously, but sort of 1/4%, one rate increase over the course of a year at this pace. But I would just say with very wide uncertainty bands, very wide. We don't really know. There are other estimates that are much smaller than that, by the way, and some of you may have read about that. That's kind of a mainstream estimate. We know that it is part of returning to more normal and more neutral financial conditions. And our strategy is to set up a plan and have it operate, and really have the interest rate be the active tool of monetary policy. In terms of speaking to the American people, I feel like sometimes I want to remind us really that that's who we work for, and that it's inflation that people are feeling all over the country, and it's very important that they know that we know how painful it is, and that we are working hard on fixing it. I thought it was quite important to do that, and so that was really the thinking behind that.
Do you think the Fed has a credibility problem?
No, I don't. And a good example of why would be that. So in the fourth quarter of last year, as we started talking about tapering sooner and then raising rates this year, you saw financial markets reacting, very appropriately. Not to bless any particular day's measure, but the way financial markets, the forward rate curve has tightened in response to our guidance and our actions, really amplifies our policy. I mean, it's monetary policy is working through expectations now to a very large extent. We've only done 2 rate increases, but if you look at financial conditions, the 2-year is at 280 now. In September, I think it was at 20 basis points, and that's all through the economy. People are feeling those higher rates already, and that shows that the markets think that our forward guidance is credible, and I think that's we want to keep it that way.
Scott Horsley, did you have your hand up? Okay. Brian, Chung.
Hi there, Brian Chung with Yahoo Finance. To expand on Steve's question about Paul Volcker, there was also a great pain that came with that as well. Higher interest rates obviously affecting households and businesses, and wondering how you kind of square what might be demand destruction. Are you already seeing that? Is the idea here to incentivize a lack of spending, to decrease consumption, to perhaps table business investments? Is that essentially what's happening through this hiking cycle? Thanks.
Well, so as I mentioned, you can see places where their demand is substantially in excess of supply, and what you're seeing as a result of that is prices going up and at unsustainable levels that are not consistent with 2% inflation. And so what our tools do is as we raise interest rates, demand moderates and it moves down. Interest rates, businesses will invest a little bit less, consumers will spend a little bit less. That's how it works. But ultimately, getting supply and demand back in balance is what gives us 2% inflation, which is what gives the economy a footing where people can lead successful economic lives and not worry about inflation. I mean, so yes, there may be some pain associated with getting back to that, but the big pain is in not dealing over time, is in not dealing with inflation and allowing it to become entrenched.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could take a step back and talk about, in March, the dot plot had, looked like steady 1/4 point rate hikes, get the funds rate up to 2% at the end of the year. Now, it seems like you're much more aggressive. So could you talk about the thinking that's behind that? Thank you.
So look, I think what you've seen is really, I would say last fall, in the middle of last fall, there was a time when our policy stance was still pretty much in sync with what the data were saying. If you remember, there were a couple of weak jobs reports, and inflation had actually come, month by month, inflation had come down till September, a few months in a row, stayed low. And then around the end of October, we got 3 or 4 really strong readings that just said, no, this is a much stronger economy. And by the way, then with the restatement of the jobs numbers, it looked like the job market was much more even and stronger in the second half of the year, but that hadn't happened yet. Anyway, we got an ECI reading, Employment Compensation Index reading, the Friday before the November meeting. Then we got a really strong jobs report. Then we got a really high CPI report. And so I think it became clear to the committee that we needed to adjust and adapt. And we have ever since then. Really, ever since then, we've been adapting. The committee moved by the time of the December meeting to a meeting of 3 rate increases, then to a meeting of 7 rate increases at the March meeting. And that process is going on, and it's clearly continuing. And that's why I say, and I actually mentioned this at the March meeting, that no one should look at any single SEP as sort of a real resting place for 90 days, because we're in a fast evolving situation, and that's what's happened. You can see unanimous vote today, of course, and I told you the guidance that broad support on the committee to have 50 basis point hikes on the table at the next couple of meetings. So you're right, and by the way, other forecasters have been doing the same thing. And it's just us adapting to the data and to the situation and using our tools to deal with it.
Thanks. We'll go to Nancy for the last question.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, I want to ask how you're able to balance your dual mandate, stable prices and maximum employment, especially when the unemployment rate for Black workers is still roughly double, roughly twice the rate for white workers?
So unemployment rates for all racial groups have come down a lot and are now much closer to where they were before the pandemic hit. So so that's one thing I would say, and that's important. But the bigger point is this: I do not at this time see the two sides of the mandate as in tension. I don't, because you can see that the labor market is out of balance. You can see that there's a labor shortage. There aren't enough people to fill these job openings, and companies can't hire, and wages are moving up at levels that would not over time be consistent with 2% inflation over time. And of course, everyone loves to see wages go up, and it's a great thing, but you want them to go up at a sustainable level because these wages are to some extent being eaten up by inflation. So what that really means is to get the kind of labor market we really want to get, we really want to have a labor market that serves all Americans, especially the people in the lower income part of the distribution, especially them. To do that, you've got to have price stability. And we've got to get back to price stability so that we can have a labor market where people's wages aren't being eaten up by inflation and where we can have a long expansion too. That's the good thing is you can have, as we've had several of the longest expansions in U.S. history have been in the last 40 years. And that's because it's been a time of low inflation. And long expansions are good for people and good for the labor market. So that's the way I think about it. I think we, our tools work. We have to think in the medium and longer term. And I do think that the best thing for everyone is for us to get back to price stability to support really a sustained period of strong labor market conditions. Thanks very much.
Chair Jay Powell, first in-person news conference from the Fed in 2 years. First half a point rate hike that we have seen since back in 2000. Also announcing plans to trim the $9 trillion balance sheet. Boy, what a rally. Take a look at the stock market. Turned on the Fed chair's comments and kept going higher. We're now at session highs where the Dow's up more than 700 points. S&P 500 up 2.4%. The NASDAQ up 2.5%. Everything rallying. Treasuries are also rallying. Yields are coming down and the dollar is weaker. The takeaway there, he wasn't as hawkish as maybe some had feared. And he ruled out the 75 basis point hike. That was the question from Steve Leisman. We'll talk to him in a moment. But if the market was thinking that was coming next, he really said the more 50s are on the table. Check out the most actively traded names here at the New York Stock Exchange as we enter this final hour of trade right now. Uber down 4%. Earnings ahead of the bell, after the bell. AT&T, NEO, and Ford continue to be among the most actively traded names every day here. Joining me at Post 9 for some instant Fed reaction, former National Economic Council Director and former Goldman Sachs President Gary Cohn. Always good to have you on a Fed day. What a rally. So it was baked in.
Yeah, I think it was baked in. I think the chairman drove it right down the middle of the road. He didn't hit either guardrail. He said exactly what people probably would have hoped he said. He gave pretty good information on the balance sheet. I think people are priced in the rate side of the equation. What they're worried about now, and I think what people are starting to talk about, is the quantitative part of the equation. We've gone from QE, we're going to QT. And I think the chairman very obviously told us how they're starting, where they're starting. They're going to ease in and they're going to expand, and we're going to the number that we were told he was going to. He even laid out, how they were going to do it, what securities they were going to sell, and the market likes that. The market has been trained to have transparency, and we got transparency.
He has this new forward guidance where he is very open about what he's going to do, and it gets priced into the market, and then we have a relief rally like this. Thought it was interesting that he opened the news conference with an address to the American people. Inflation is too high. We get it. He used the word attentive a number of times, and he used the word expeditious a number of times in terms of how many rate hikes we're going to see to try to correct it.
Yeah, he opened up talking inflation's too high, labor market's tight. He talked about the PC being 6.5%. He talked about without food and energy, it being 5.2%. And then he used the new word, adapting. We're adapting.
Well, because their view on inflation has totally changed.
We're adapting. So I thought that was very interesting. In his prepared remarks, he came out and talked about adapting. We have a Fed that is now adapting to the new inflationary stance that we live in.
So what does it mean? We'll get another 50 basis point hike?
So look, he also mentioned, if you listen clearly, he said 250s. I think he admitted to 250s. Sarah, I think if you take a step back and you look where we are, I think we have 5 Fed meetings left the rest of the year. There's no August and no October Fed meetings. He admitted 2 already. I think most people think Fed funds end the year around 3%. So that's probably conventional wisdom right now. That's where the market has it priced in. That would most likely mean we would have 350s and 225s. We don't necessarily have to have the 350s in a row. So the chairman already told you it looks like 250s for the next 2 meetings. The next 2 meetings, June and July. Then we take a break. We actually have August off. So when we come back in September,
25,
the chair will look, he'll have a lot of data between now and September. So if things are starting to moderate, inflation's starting to moderate, he's having his effect on demand, which the chair also admitted. He can't deal with the supply side. He can deal with the demand side. If he's if he's having the outcome effect he wants on demand, then he's got optionality when he comes to September. If he's not having the effect, September could be another 50. And then you could have November and December be 25s. So I think he's laid out sort of the roadmap for the next 2 rate hikes being 50s.
So what does it mean, Gary, for the markets? Because stocks are zooming here. And bonds are rallying. The curve is steepening. The 2s10 steepening. It all makes sense. It's priced in. But do you see a potential for more of a rally beyond today on this idea that the bond market just got too hawkish?
Look, Sarah, I think a lot of people have priced all this in. And the fact that the chair came out, he acknowledged where they were. He reconfirmed they're behind the curve. He said we're adapting. We're going to do what we have to do. We're no longer talking. He didn't mention the 8 or 11 increases that you mentioned last meeting. He's now talking about 50s. I think the market's starting to say, okay, we've got this pretty well priced in. I don't think there's a lot of surprises out there. We've taken a lot of the fluff out of the market. We've taken a lot of the hot air out of the market.
The excesses.
We've taken the excesses.
A lot, yes, the excesses have been removed.
Good word. We've taken a lot of the excesses out. We've now got some real value. So the stock market today is reflecting some of those values, some of those asset prices that have been beaten down. And the rate market had already moved. We already saw 10-year rates more than double. We've already seen, 2-year rates more than quadruple. And so we've had the movement. The market has put the movement into rates already. And the market's sort of getting a vote of confidence that they're right where they've got things priced. And it's probably not going to get much worse than that. And so that tends to lead market practitioners to say, okay, we sort of understand the outcome, and we maybe have a little bit more predictability today than we did last week. And we like predictability. And therefore, we are willing to put a little bit more risk on the balance.
And I think also even hawkish Powell isn't too hawkish. Could be more hawkish. Every sector's higher right now, by the way. Dow's up 700, more than 700 points. Every Dow stock is higher. Gary, stay with us. We do want to bring in our senior economics reporter, Steve Leisman, who was part of that news conference, Steve, and I thought asked the money question, which turned the market about consideration of a 75 basis point hike.
Yeah, it was the question to ask, and I was lucky to have it to be asked, being up early in the roster there. But I think what's really important, and I think I just heard the tail end of what Gary was first saying when I came here. I think Gary has this right. Here's the deal. 50 is the new 25, and 75 is the new bell-bottom jeans. And I mean that by, it sounds like 50 is the new base case. And I think that's what Gary was saying, essentially. He said, well, you know what? Let's listen to what he actually said, and let's listen very carefully to what he says at the very end here. We'll come back and talk about it on the other side.
We need to really see that our expectation is being fulfilled, that inflation, in fact, is under control and starting to come down. But again, it's not like we would stop. We would just go back to 25 basis point increases. It'll be a judgment call when these meetings arrive. But our expectation is, if we see what we expect to see, then we would have 50 basis point increases on the table at the next 2 meetings.
The next 2 meetings, that's what he said. So here's what the market is so excited about. It's kind of interesting. The market had priced in 4 50s before this meeting. It got one of those 50s now, so call it 3 50s, and one of those possibly a 75. Now it has 2 50s for sure, and now he's taken 75 off the table. don't know how great, but it's interesting to me, Sarah, how incredibly discomforted the market was from the idea that a 75 was hanging out there, and how comforted it is that the 75 was off the table, but instead there's 250s for sure now. Well, pretty much for sure.
I agree. I agree. I was surprised at how far the market went, I guess, Steve, at pricing in a 75 basis point hike, because it's not like any, I mean, you talked to Bullard about it. It wasn't even his base case, and he's the most hawkish one out there right now.
That's what started all the nonsense, you know. And I don't even, you're right. Jim didn't make a strong case for it. I think Jim was simply not taking it off the table. He said 75 basis points is possible, but it's not my base case. Mary Daly said 25, 50, 75, we'll debate it. And then what happened is the chairman came in and put the hammer on that discussion. He came in and he put the hammer on. He said 75 is not going to happen. And I think, to be fair here, Sarah, the idea for the market that there are some rules or some restrictions around how much the Fed might make the market digest every month, I can understand how that's comforting. If the whole thing was random, that's, I think, what scares the market. Now I think they have an idea of the trajectory of the Fed funds rate for the next at least couple meetings.
Making new highs here of the day, up 775 on the Dow. Steve Lietzman, thank you very much. The question, Gary, is it going to be enough?
Sarah, the other thing I'll point out is we had a unanimous vote. True. Remember, a month ago, we did not have a unanimous vote. So what Steve's saying, and we're agreeing, is we got to 50, and there seems to be universal consensus in the room that 50 is a good number. The chairman said 50 for the next two meetings. So, you know, now there's unanimity in the room. Well, so it's a big difference than dissenting votes.
In that soundbite, also what you heard was, if anything, we move from 50 to 25. We don't move from 50 to 75.
Exactly.
And that's very not hawkish. I guess my question, though, is it going to be enough? If we have not seen the highs of inflation, he mentioned all of these new shocks that we're seeing from Ukraine, from China, which was now mentioned in the statement for the first time. Are they going to be able to get a handle on it?
Well, I think the chairman also admitted something that everyone knows. They can deal with the demand side with interest rates. They can't deal with the supply side. So to the extent that we continue to have an oil shock, and I said a month ago, I'm not worried as much oil as I am food. Yeah. I'm worried about food. I'm worried about grains. I'm worried about the agricultural products. The oil's out there. We can get it if we need to get it. The grain market is the one that scares me. And we're just now in crucial parts of the grain market. We're in certain harvesting seasons for winter wheat. We're in planting seasons, and they're not going as well as we'd like them to go for drought conditions, other weather conditions around the world, and war conditions. So
can't plant crops in Ukraine in the middle of the war, and there's nothing the Fed can do about that.
That's absolutely true. Yeah. And look, I think the chair acknowledged that as well. If we're seeing some of these inflation numbers, and he went out of his way to quote the ex-food and energy inflation number, they realize they can't deal with the food and energy number. They're going to deal with the core numbers. What he can tamp down is some of the wage inflation. And look, yesterday we saw the JOLTS data. We saw 11.6 million job openings. We saw 4.6 million quits, which is, you know, the quits number to me is almost more interesting. It's a series high. People don't quit a job unless they're going to get another job at a higher price, at a higher wage, and they're confident they're going to get that other job.
So, meaning the Fed is going to, it's going to be tricky for them to bring this. Look, are you saying that inflation is entrenched?
It's not easy. Look, this is not easy. No one should think what Chairman Powell is trying to do is easy. He's trying to soft land an economy. They are behind the curve. They're not out in front of it. It would have been a lot easier had when we seen the beginnings of inflation, which, look, they thought it was supply chain issues. They thought it was pandemic related.
More transitory.
We thought, I didn't say the word transitory. I refuse to say that. They thought it was supply chain issues. They thought it was pandemic issues. They thought it was restarting the U.S. economy and it would come out of the system. Not a totally irrational thought. This was real demand. This was real economic factors at work here. So they're behind the curve. And so they've got to figure out how to get there. The way, the piece that he can control, and he admitted it, he can control the wage growth by tamping down economic growth. That's where he has to go.
So what is that going to look like? And is it going to lead us into recession? Because that is also the question that the market's been trying to figure out.
So where we are today, and you and I just heard this over the last 2 days at Milken.
Yes.
You know, corporate America.
Well, the overnight flights back.
Exactly. Corporate America feels good. If you talk to anyone in a consumer-facing business, they'll tell you business is good. Business is robust. Maybe people are trading down a little bit in product, but business is still good. Sales is very good. You look at corporate investment and capital investment, it's still very good. People are out spending money. We just talked about job creation. Job creation is here. So look, for the foreseeable future, which I will call between now and maybe the end of the year in economic terms, the economy looks pretty strong. Going into next year is harder and harder to predict because we've got the Fed raising interest rates. We've got the Fed starting to liquidate their balance sheet, which I think people should spend more time thinking about what that means. Not only are we going from a buyer of securities, we're stopping buying, we're flipping it around and being a seller of
Someone's
securities.
got to buy those treasuries.
So someone's got to buy those treasuries. So look, we may end up in a recession. I do know something. At some point in our lives together, we're going to see a recession again. I guarantee you we're going to see a recession. So we have to look forward. It doesn't feel like we're there now, but we could get there. But there's a lot of positive factors as well. The good news is we're starting with a lot of positive momentum.
True. I just want to point out what's happening in the market because it is a broad-based rally and it's picking up steam as we go into the close. Very strong. The Dow's up 2.5%. Every Dow stock is higher right now. Home Depot is the biggest contributor. Again, that's where some of the pain has been. Consumer discretionary, housing related. Goldman Sachs, your old firm, also contributing to the Dow rally a lot. Honeywell, 3M, IBM. It is broad-based. Look at the S&P 500. Every sector higher. Energy's in the lead, up 3.5%. It was higher all day long on this EU proposal to cut off Russian oil and gas. But the financials have joined the party big time. Utilities, industrials, healthcare, staples, materials, consumer discretionary. Tech's having a solid day right now. The NASDAQ 100 is up 3%. And that's really where the brunt of the pain has been on higher interest rates. Would you buy Netflix right now, down 70% this year?
Look, it's not what I do for a living. I don't buy single stocks.
I'm just saying, some of the beaten down parts of the market where valuations have really corrected, like tech, appealing now that we know from Powell that what the plan is and it's already in the market.
When I was here a month ago, I talked about multiples. We had to see a contraction in multiples. When the Fed is throwing the party and they're throwing money all over and money is easy, money has to go somewhere, so multiples expanded. And we saw multiples really expand. When the Fed's tightening and they're taking liquidity out of the system, multiples naturally have to contract. The question is, did the market contract the multiples enough?
That's what I'm asking you.
To buy it right now. It feels like we've clearly gotten there, but I'm not smart enough to say absolutely we've gotten there. Jump in. It's not what I do for a living.
What about bonds, though? Would you be a buyer of bonds here on the fact that they got pretty stretched also on the downside? 10-year reached 3% yesterday.
Look, it looks like you're getting some return here. You're getting some more return. But we've seen very orderly moves in the credit spread markets. So, when you look at what's going on in investment grade and you look at what's going on in high yield, we have not seen really volatile markets or irrational markets. We've seen those credit spreads move, in a very, very orderly fashion. We've not seen massive widening in credit spreads. So the credit markets have behaved very orderly. So, there's opportunity there. You're definitely getting a much higher rate of return to buy a high yield bond today than you were 3 months ago. So there seems like there are opportunities in some of those markets. That doesn't mean that the underlying yields can't go higher. I think that the chairman made it pretty clear. We're going to do 250s. We're going to take August off. We'll come back in September, and we'll see. If we need to do another 50 in September, we'll do it. If not, our next muscle memory is to go back to 25.
Finally, Gary, there's a lot of 900 on the Dow. It's all you.
No,
just kidding.
It's all you.
Chair Powell speaking, turn the market around, and it has just continued to climb to new heights, up 900 now on the Dow, almost 3%. So really a relief rally more than anything.
I'm watching IBM over my shoulder, up $5.11. Come on.
Gary, Vice Chair of IBM, should note. But here wearing another hat today. A lot of talk about neutral. We're going to hear about neutral. Neutral. What is it? What is neutral? What is the significance of it? And should the Fed be telegraphing some sort of neutral rate, and should the market be worrying about going above neutral into restrictive? Explain these words.
You and I have talked about neutral a lot. Neutral is one of these concepts that if I could make it disappear, I'd make it disappear. I'm not sure the Fed might make it disappear if they could wave a magic wand. This miraculous rate where we're not contracting, we're not growing the economy, and it's miraculously neutral today. Is it the same rate tomorrow? was at the same rate yesterday. You know, it's a hypothetical place where we're basically at a standstill. It's a nice concept, and I'm sure we can pass through it for a millisecond, but I'm not sure we can stay there. It's a place that we can stay and say, look, our target is to be neutral, and we're going to stay here for a long period.
Really quickly, because you have such a good feel on the markets, does the Fed still? He was asked if he worries about his credibility. He addressed the American public. We understand inflation. We know it's painful. They were late, as you said. Do they still have credibility when it comes to this fight?
Look, I think the opening prepared remarks clearly had to do with the fact that the chair is trying to assure the American public about their credibility, that they're on top of the situation, that we should feel confident that they can attack inflation, that he was trying to be sympathetic, that he feels people's pain when they're holding down the gas nozzle and, you know, it's becoming a triple digit number to fill up your gas tank. So I think the chair tried to appeal to the public today, which was a good idea. I think the jury's still out on the credibility. You know, he's late, but doesn't mean the story, the last chapter of the story has been written. If he miraculously lands this relatively softly, or if he even lands it not hard, I think he will have credibility. And I think he went a long way today of telling you, I've got 2 50s lined up, I've got some time off, and we're prepared to do more. And so, look, he's going to need things to go well. You know, he's as you said, I'm in control of demand. I'm not in control of the supply side. And that's where a lot of volatility is right now.
Gary Cohn, thank you very much for the time and the analysis. Come back soon. We got to talk about the midterms and this new outlook. Meantime, Dow just roaring here, up almost 900 points. Technology also on a tear. Apple, Microsoft, Facebook, Tesla leading the triple Qs. Coming up in the market zone, Uber and Lyft both sitting out this sharp rally on the back of earnings. We'll tell you what Lyft's president is asking from investors as his stock loses a third of its value today. Plus, we'll talk exclusively to CBS CEO Karen Lynch about her better than expected results and guidance. And do not miss Double Line CEO Jeffrey Gundlach, his reaction to the Fed and the market rally. That's going to be at 4 p.m. on Closing Bell Overtime. We'll be right back.
Have a number of money, man.
Yeah, Davis, I'm very sorry to hear about that. If you still owe $90,000 and all that, and you've been paying $800 some 22 years, I mean that's really sad. But you know that the people on the other side, the person that was getting the loan was just, you always got to look at that where they don't care. They're trying to make money for themselves. They could care less about anybody else, and that's what's really bad about people and about America, about people in general around the world. Let me look at this. $800 times 264 months. Yeah, dang. Yeah, it's $211,000. Yeah, $212,000. Yeah, unbelievable. That's just sad to hear, sad to see. And you know, did you even try to find out what the difference would be from a 30 years to a 15 years? You know, I know that's more money, but do you know anything about, Davis, that if you put an extra payment in there every 2 weeks, just say your loan is $800, you're paying $400 each 2 weeks. That cuts down your time and interest and all that by from a 30 to almost a 15-year loan. So, you know, and what I have found is truthfully is afterwards and wisdom of getting older, because right now I'm 50. What I knew back when I was in my 20s and is definitely not even close to what I know in my 50s. So, but I have made those mistakes as well. And, you know, right now I'm still paying for a car, which honestly I could have probably bought, but I needed to build my credit. So I'm having to pay a 21 to 24% interest rate each month, so not very fun at all. So, but to be able to buy something later on, I had to bite the bullet and do something else. So, what I was doing is slowly going up, each month with a car loan and getting it paid off and a timely manner will definitely boost up my credit. And I think it's at 675. So, but still get turned down for loans. I guarantee you that. The modification only allows me to pay $800 monthly. Material date is 2035. I drive Priuses because I drive so much and everything. With the gas prices and everything, I love to have a truck. I'd love to have a muscle car and all that, but I don't want to pay for the fuel because I drive lots of miles. So, but I don't want to give it to any kind of people over in the Middle East or whatever. I just want to pay the $2, and I was paying $2.45 a gallon for the E85, and now I think it went up to $2.65 in one day. It's a 20-cent jump. So, really appreciate you coming on here and talking and all that. So, Fed Chairman Jay Powell is, in my opinion, needs to bump it up even more to get to inflation and all that, under control and down. So, but eventually what somebody's going to do, just like you, Davis, if you bought a house right now for $300,000 or $400,000 and all that, and you're going to pay an extra $1,800 to $2,200, once that interest rate comes back down, you're going to pay a closing cost of whatever it is, just because that person that's doing the loan and the loan guy is going to get his kind of money, but you're going to save it over a period of time. But I would stress to you, pay every 2 weeks. And if it's saying it only allows you to pay $800 monthly, I would still try to. I think they would just take the money. I sent my check from my bank account to the loan people, to the different address. It was their headquarters that I sent it to, and their billing cycle was at a different place. They still accepted it and still put it on my account, and I got it the statement the next month, and it still says, "Hey, you paid your car payment. Thank you. And the next car payment is due May 10th. So, what I need to do is every 2 weeks is give out money, or even put every 2 weeks, which I somewhat financially okay. I do make great money. I'm very blessed that way. But I have to work a lot. That's the only reason why I make great money. Because I do work a crap load of overtime whenever there's possibility of that. But not everybody wants to do that. Not everybody is capable to do that. I just don't have my kids all the time, so I have that chance to do that. But it's still no fun. I'd rather be here. I'd rather be talking to you guys. I'd rather be learning stuff. I think this is definitely a passion of mine or calling of mine, that I like learning what's going on. So get back to what's going on television and everything. So Davis, thank you. Appreciate it.
And, clearly this is our strategy in action. We rolled out a strategy in December. We're making very strong and meaningful progress, and we're meeting consumer demands across every single one of our businesses.
What about the COVID factor, though? How do you calculate? It's obviously been very helpful, and the retail sales were strong, prescriptions, but with the vaccines and the testing demand, how do you forecast what that's going to do to the rest of your business for the rest of the year and into next?
Yeah, so Sarah, obviously what we've learned with COVID is most unpredictable, variant that we've seen. What we've predicted is that
Testing, we'll continue to see testing, but we'll continue to see a decline in testing. We factored in the fourth booster, but we'll continue to see a decline. But we've got strong performance across every single one of our businesses. We're having good results from our front store. We're seeing, we've taken script share 8 quarters in a row. Our healthcare business has performed quite strong. We're, benefiting from our strong revenue growth in Medicare Advantage, and we had the strongest selling season, for the first quarter in our pharmacy business. So solid results all around. What about inflation, Karen? Topic du jour. Just heard from Fed Chair Jay Powell. They're focused on it. How is it impacting you? Everything from the drugstore business to the prescriptions to insurance. Where is it showing up the most, and how are you coping with it? Well, it's interesting because it shows up across each of our businesses very differently. In healthcare, inflation will have an increase in premiums. We'll offset some of that through the change in interest rates. We have a strong bond portfolio. So as we're selling off bonds, we recognize the realized capital losses, but we'll see gains over time in that portfolio as those higher interest rates kick in. In our pharmacy services business, we haven't seen a big impact. All the brand inflation, generic inflation within our expectations. And then in our retail business, we've had very strong pricing power. We have alternatives through our store brands, and our subscription program are offsetting some of the impacts of inflation for our customers. Quickly, Karen, just in light of what happened yesterday, the leak of the document from the Supreme Court on potentially overturning Roe v. Wade, and some of the moves we've seen from states like Texas to crack down on abortions. I'm curious, in your insurance business, what you're seeing from companies, whether they're making moves and adjustments to cover abortions out of state and to make reproductive care more accessible, even in the last 24 hours. What are you seeing? Yeah, so Sarah, we've been talking to our customers for a long period of time. They've been interested in, what opportunities they have in benefit designs. We're working very closely with them on the choices that they want to make relative to their benefit designs, and we'll work with them in making sure that we administer those plan designs in accordance with applicable law. And, every day we're having those conversations with customers, and we've seen an increase in the conversations today. Yes, I would expect that companies are doing that. Karen, thank you for the color. Great to talk to you on earnings. Thank you, Karen Lynch, CEO of CVS Health, which is jumping 5%, along with the broader market, which is sharply higher right now. Top investor Bill Gurley from VC firm Benchmark was on Tech Check earlier today. Here's what he had to say about sky-high valuations. Listen.
When you have a frothy world and everything trades on price to revenue multiples, people, talk about all kind of numbers and they don't talk about the bottom line. So you have a ton of, this adjusted that, and people want, real earnings. They want real free cash flow now. And so all these companies that have lived in this, high froth environment for the past decade, they kind of have to readjust. And I think the sooner they do it, the better.
Question, Mike, have we started to see that from some of these newly public companies and other sort of frothier parts of the market where they are more focused on things like cash flow and profitability, given the market's complete mood shift here that Gurley talked about?
Yeah, I would say that the peak in buy it at any price based on, high sales multiples and the total addressable market and forget about profitability, that's probably 15 months ago was the peak. So we've obviously had a lot of those types of stocks crash. The IPO market's basically been closed for a few months right now, especially to those type of high growth companies. To me, the interesting question is if that psychology pervades the private market, private companies, what is it going to mean for the pipeline of spending, which goes into things like Facebook ads to build brands for startup companies? I think that's the big question for investors right now, is exactly what the profit trail that goes from indiscriminate spending of venture capital money without an eye to profitability toward the profits of existing large companies that we now try to place a multiple on.
Session highs up 3% right now on the S&P. We've been showing you the Dow tick for tick up 950 points right now as we head into the close. Take a look at the ride-sharing companies, though. Uber and Lyft not in the celebration, under heavy pressure today. Uber reporting a narrower than expected loss and a revenue beat. The company also says it won't have to offer significant incentives to maintain its driver base, which is at a post-pandemic high. Meantime, Lyft shares plunging there, down a third of the company on weak guidance, warning it will have to continue spending on those driver incentives. Lyft President John Zimmer weighing in on the stock sell-off this morning on Squawk Box. Listen.
It's a choppy market environment right now as a whole. And the market wants to understand the business model coming out of the pandemic. And we asked them to give us one more quarter to make investments that we feel like are the right thing to do for long-term profitability.
Not giving them the benefit of the doubt today. Deirdre Bosa joins us. Uber says it doesn't need to spend significantly on driver incentives, but with Lyft continuing to spend, will Uber eventually have to? Is that why it's down today as well?
Yeah, I think that's exactly why, Sarah. I think the market doesn't really believe Uber when they say that they're going to get to free cash flow, they're going to get to a better measure of profitability. If their biggest competitor is going to be spending on driver incentives, that is going to change the balance once again. So will Uber have to continue to invest? I did speak to CEO Dara Khosrowshahi earlier, and I said, what makes you so confident that this is the right strategy, that you're not maybe giving up your lead to your competitor? He says that he's confident in the super app strategy. So they're getting drivers and couriers from the delivery side, from the ride sharing side. We'll have to see how that plays out. But to what you and Mike were talking about in reaction to that Bill Gurley thought that you just ran, these companies are well aware that they need to start showing a better measure of profitability. It used to be adjusted EBITDA. They've hit that. Now they're talking about free cash flow in the case of Uber. So we'll see when they get there. But right now, I think based on what the stocks are doing, the market doesn't buy it.
So just to be clear, Deirdre, not a problem with demand, right? Certainly not from Lyft. Didn't seem like it from Uber. People are going out again. It's all around this driver shortage issue and what they're going to have to do to fight it. Is that the big issue?
I mean, Lyft is near pre-pandemic levels. I believe Uber is there. So demand isn't the problem. They're, cautiously optimistic that this year is going to be better than last based on what happens with future COVID trends. But it is the driver supply. Yes, many of them left. We are in a tight labor market. This is the independent contractor model, which they say employees like because it gives them flexibility. But we haven't really seen that in a big way because they are having trouble getting drivers back on the platform. So yes, Sarah, that is the problem.
Deirdre Bosa, Deirdre, thank you. And do not miss the CNBC interview with Uber CEO Dara Khosrowshahi tomorrow, 8:30 a.m. on Squawk Box. Stocks are surging. The Dow is up 960 points here into the close. David Zervos, wouldn't be a Fed day without him, the chief market strategist at Jefferies. What a reaction to Fed Chair Powell. You think it was the fact that he ruled out that 75 basis point hike and confirmed market expectations?
I think that's a part of it, Sarah, but I think it's just, we now know what we're dealing with over the summer. We've got 250s pretty much locked in. We know what an aggressive policy response to this inflation outcome looks like. And a lot of us didn't know exactly what that was. The committee had to debate that. They debated it. They came up with a unanimous decision. I think that's important. There's not a lot of dissents. They're going to go pretty strong, but the market was pricing in the risk of something stronger. And Sarah, just not to get too ahead of ourselves, this is exactly where we were Thursday, Friday last week in terms of S&Ps, the dollar, and a lot of other indices that we would look at for financial conditions. So I think the market just saw the beginning of this week and got a little bit nervous that it could get more aggressive, especially after last FOMC meeting when they delivered a very hawkish S&P relative to market expectations. So I just think it's a standard relief rally to a Fed that is not as panicky as some might have feared. And I think that's important.
Well, also big reaction in bonds. Yields came below that 3% on the 10-year yield, a big bounce there. Bull steepening in the yield curve. The dollar's weakening. Even the Japanese yen is strengthening. Powell basically did it all. Investment implications, though, beyond this just reaction in the near term.
We're going to get hit pretty hard with monetary accommodation removal. The risk was we were going to get hit harder. So it was just a question of how hard he was going to punch. And the punch wasn't as severe as feared. That doesn't mean that he can't up the ante as we go through the summer and the inflation data don't cooperate. We all will be waiting to see that. I think the other thing about his press conference that was important, Sarah, is he is so focused on the inflation. He's not talking about any serious cracks in growth or the labor market or the housing market. So you really, really need to see this inflation come down in a relatively I don't want to say aggressive, but in a calculated and continuous way. Otherwise, he's going to have to change course a little bit. So it's a reprieve. There's no question. We get a little bit of a springtime reprieve from a less than aggressive Jay than we had feared. But generally speaking, I think we should all be on the lookout for something that's more aggressive in the future, not an immediate pullback and say, oh, all is clear. We nailed this. It's good, even if the inflation data come out okay over the next
Also, to your point, and the fact that he was so serious, speaking to the American public about inflation and the duties that they have, I do wonder if if there is a policy mistake, it's more in the camp of recession than in letting inflation stay too high for too long, and they're willing to tolerate that. So, David, that seems to me to be a big risk for stocks beyond today and maybe the near term.
Yeah, I'm with you, Sarah. I think they're going to err on the side of really pushing inflation back into a hole. Even if we get good numbers, I think they're going to still remain cautious. There was a point in the conference the press conference where someone asked him about fiscal policy, and he made an off-the-cuff remark about how, let me just figure out my job, which is getting inflation down here, and then I'll be able to give some advice on fiscal policy. I think there's a bit of there's a bit of self-deprecation going on, a bit of, soul searching going on that just says, hey, we got to get this done. They're hoping that this is enough. The market priced in a little bit more. They gave them a little bit less. It feels good today. We're only back to where we were last week, which is still down 10% on the year. I wouldn't get too overly excited about some runaway in risk assets here. That's my take.
Mike, where does the market on the notion of a soft landing and whether he can pull it off?
Well, first of all, I don't think the market is presuming a hard landing, because if that were the case, we'd be a good deal lower. That would mean a recession. That would mean a lot lower earnings that we're now contemplating. So I think there's some decent probability assigned to some version of a soft landing. There's always scares along the way, whether you get to the soft landing or not. So I think it's going to just take it in bits, not necessarily try to project, 9 months ahead to say where this all ends up. And I think for now it's palatable, given all the risks we've already discounted at the moment. Also, another piece of it that the market seemed to, grab onto from the press conferences, Jay Powell said the obvious thing, which is their forward guidance has had a lot of effect. It's priced into the market a lot. So we're already kind of there in terms of, the known tightening trajectory for the moment.
So, David, would you be buying tech stocks? Nasdaq's still down about 17% this year. Sounds like you're not fully convinced.
Yeah, not really. Look, I think we could have a nice little bounce here. Maybe we go back up another 100 points in the S&P, and your short-term views are maybe you sell around that. But I think this is a covered call kind of year. That's how we've set it up from the beginning of the year. I don't see the big runaway upside. I'm kind of coming to grips with the idea that the runaway downside isn't there either, and maybe that's all what the VIX is starting to price in today, coming down so hard. But I think the upside is going to get pushed very hard against by the Fed. They're going to use that as an opportunity to be more hawkish and get inflation down faster. But when they see the S&P down 13 to 14, the Nasdaq down 23 to 25, they probably don't want to push as hard. They don't want to create anything too messy. And maybe that's what we started to see.
S&P now down 9.8% for the year. David Zervos, thank you for your first reaction from Jefferies. Really quickly, Mike, what are you seeing in the internals?
Oh, it's positive. I mean, obviously, it had a big kind of buying binge once we did get clear of the Fed meeting. You see there, 4 billion shares advancing to 500 million declining. So basically, very comprehensive. Banks versus energy over the past 6 months diverged, right? This measures why when inflation became a threat to growth and credit, as opposed to just being a good thing, and now both curling up. That's a slight net positive for the moment. The VIX getting crushed down to 25. It was 36 a couple of days ago. So that's another good spike in the chart. Market trying to stabilize here. The VIX futures are back in an orderly direction as well, Sarah.
As we go into the close, a 3% gain for the S&P 500. What a reaction to Fed Chair Jay Powell. The Dow is up 935 points right now, just about at the session highs. Every sector is higher. Every Dow stock is higher. Energy leading the way. Communication services, technology, and materials are your 3 best performing sectors. You've got names like Apple, Microsoft, Tesla, Meta, Alphabet, Nvidia leading the Nasdaq right now, which is going to go out with a gain of 3.2%. That's it for me on a crazy Fed day for Closing Bell. Send it into overtime now with Scott Wapner.
Sarah, thanks and welcome to Overtime. I'm Scott Wapner. You just heard the bells. We, of course, right here at Post 9 are just getting started. And we go right to our talk of the tape today. A historic Fed decision, what it means to your money and stocks. which jumped and jumped big time on a very specific comment from the Fed chair. So, is a broader rally really ready to happen? The biggest question of all, though, can the Fed actually pull off its most delicate balancing act in decades? Let's ask Double Line Capital CEO Jeffrey Gundlach. He is with me live today in a CNBC exclusive interview. Welcome back, Jeffrey. It's good to see you again.
Hey, Judge. Good to be back on Fed Day again.
Yeah, it sure is great to have you. We said it's a historic move today by the Fed. Your first reaction is what?
Well, I want to put it in context to start with. We all know that the Fed was far, far too dovish last September and perhaps into December. And then last Fed meeting, there was a lot of talk about we're going to get rid of inflation. We're going to bring inflation down. We're going to bring inflation down. And so we basically have those as the goalposts. We had way too dovish, and then we had a pretty strong commitment. And that was supported, of course, by short rates going up a lot, from only about 15 basis points for much of last year up to basically close to 3% on the 2-year. And as I've said in past appearances, the Fed always follows the 2-year. But the one thing the market was really worried about, and we thought at Double Line overly worried about, and I think it turned out to be the case, is that everybody knows that the tools of the Fed are very blunt. And if you want to put it a little bit derogatorily, it's almost like Mr. Magoo and his jalopy. And he's driving around and he doesn't really know where he's going, can't see that well, but he knows when he's going to hit something or after he's hit something. And the problem is there. And the markets were worried that Mr. Magoo was going to start accelerating in his jalopy in terms of perhaps talking about 75 basis points. And that's a speed that jalopy going along at might really legitimately cause concerns about a recession perhaps even this year. And I don't think that's going to happen. I've talked about that before. And so there's a relief rally for sure. One thing that hasn't been talked about is that the yield curve, the Treasury yield curve, has been bumping up against some pretty massive yield resistance for a while now, which is, the high on the 10-year was 3% back in 2019, 2018. The 2-year Treasury got up to about 3.25%, and there's tremendous amounts of yield resistance there. So it's not surprising that we got a steeper curve. The long end can't seem to make up its mind on what to think because, there's certainly some economic slowdown that one has to think is baked into the cake here with the roll-off of all the durable goods and non-durable goods, consumer consumption, which is still very, very elevated and needs to come down very substantially to get back to trend, which had been convincing pre-pandemic. So we expected a rally. I mean, I do think that we may be seeing the high in the dollar now, that we're starting to get some relief from the short end of the yield curve. So I'll stop there, Judge, and let you follow up.
No, it's interesting because you really do allude to what I'm going to call the moment of truth today. And I want you to listen to this exchange from our very own Steve Leisman and the Fed chair because it ignited this rally. Jeffrey, let's listen and we can react on the other side.
You talked about using 50 basis point rate hikes or the possibility of them in coming meetings. Might there be something larger than 50? Is 75 or a percentage point possible?
75 basis point in an increase is not something the committee is actively considering.
The moment of truth, wasn't it, Jeffrey?
Absolutely. I thought Steve just nailed that question. I was hoping that someone was going to ask it, and he asked it in such a direct way. I think that's commendable. Also, I commend Jay Powell for giving a fairly specific answer. And that's exactly what I'm alluding to, where I'm saying Mr. Magoo was not going to step on the accelerator and go crashing into a dumpster somewhere. So we're still in a Mr. Magoo situation because the tools are blunt, as Jay Powell himself admitted. But at least the 75 seems for real off the table, at least at the coming two meetings. And what the market loves always, Scott, you know this, everybody that's a certainty frequent watcher of CNBC knows, they want certainty. They don't want, right, they don't want overly hawkish talk. They don't want maybe a 75 showing up out of the blue. And you got a very crystal clear answer in that. That's when the 2-year Treasury yield just plummeted 15 basis points. And that was all clear for the stock market to start a pretty substantial short covering rally, which I think stocks were in a very similar position prior to this meeting as they were prior to the March meeting. And that is the VIX was very elevated. There was a lot of uncertainty and fear. And the VIX above 35, again, we talked about this in March, Judge. I said when the VIX is above 35, you're supposed to be getting less bearish, not more bearish. And indeed, that level turned out to be a good buy again. So it looks to me like the markets are probably going to be in a better position for the next couple of weeks than they were in the past month.
I flagged that exchange that we had on March the 16th, where you specifically referenced the VIX at 35. I don't care how bad the tape looks. I don't care how bad the geopolitics look. You said you're supposed to get more bullish. VIX was at 35 the other day, dropped down a lot from there.
It's down a lot today, and it should be, because, that's what happens when you get a 1,000-point rally off of an uncertain period. So, yeah, we talked about foreign stock markets. The European stock market continues to be a good performer. It's about the only area that's doing something positive. And interestingly, with the carnage that's in the bond market, in the corporate bond market, and in the emerging market, particularly the high-yield corporate bond market, it's amazing that the emerging market equities are doing as well as they're doing. It's a sign to me that, and I talked about this in March, still haven't bought emerging market equities, but we're taking a real hard look at it, because if the dollar falls, the dollar index may reject this triple top, which was 2017, 2020, and now 2022. And if it drops back below 102, I think that's the signal to buy emerging markets. We're not very far away. So we've owned Europe, we've owned commodities, we've owned the long bond, which has been the poorest performer of our diversified asset mix year to date. But I think all of these things, when you glom them together, this highly diversified portfolio approach that I've been recommending for 2 years now continues to work. And this year it's been driven by commodities. The commodities have been the performer that's good. Stocks are a mixed bag. Some of them are up a little, some of them are down. The NASDAQ's not very good. I haven't advocated the NASDAQ. And then still cash is there for tactical investing, like you might have wanted to invest some cash late last week because of the extreme situation on the VIX. So I feel like we're almost in the same spot as we were last March. It's been a little bit of a rocky road along the way.
It leads us to this question I asked at the very top of our program before I welcomed you into the show today. It's the multi-trillion-dollar question. It's, can the Fed pull this off? Can they do what seems to be so incredibly difficult? To that, Jay Powell obviously was asked directly about that. A good chance to have a soft or soft-ish landing is what he said. It's not going to be easy and may depend on events that are beyond our control, but he seemed to suggest that he's confident enough that they can pull this off. You've doubted that. Where are you today?
Yeah, I don't think that was his finest moment in the press conference. I mean, he has to say that. I understand that. But I thought by saying soft-ish, it sort of showed a little chink in the armor. I think he knows that the odds are not as good as 50-50 that he can pull off a non-recession in, say, the 18 months ahead. There's just too much normalization of the economy. My favorite chart is to compare durable personal consumption spending year over year, non-durable personal consumption spending, and service year over year personal consumption spending. And those three categories, which are all very different, went up in lockstep, almost exactly the same pattern and distance from point A to point B for the 4 years from 2016 into the pandemic. And then, of course, they all cratered. And then thanks to the government stimulus, we had an explosion of durable goods spending. It's up 30% above trend right now. And that's a very convincing trend that was in place for years. Non-durable spending is still elevated at 20% above trend for those years. And service is back to trend. So these are going to be very substantial headwinds for the economy in concert with the fiscal drag. So when I put all of that together with the yield curve, which has inverted, not for long, and is now de-inverting, I like to tell investors, don't start throwing celebrations when the yield curve de-inverts. The yield curve always de-inverts prior to recession. So it's not a sign that we're further from recession. The one thing you might take solace from with the yield curve is it stayed inverted for such a short period of time that you could say it might be a false signal. But I'm going to be watching the yield curve very, very closely. We're now at about 25 basis points, 2s, 10s. we were inverted. We've been about flat 5s to 30s until the 75 basis point Steve Leisman moment that you referenced. And now that's steepened out some. So we're going to be watching that very, very closely. But I think the 4 terrible months for bonds in terms of returns, I think that string is going to be broken here, hopefully in the month of May. But this has been one of the worst 4-month periods in the entire history of the Treasury and the investment grade bond market, worse than any 4 months. Forget about year-end start dates. I'm talking about any 4 months ever going back to 1978. And we all know how volatile interest rates were in the late 70s. So I think we deserve a break from all of these negative bond trends. And I think Jay Powell's, I don't believe his assurances that he can pull off a soft landing. But the fact that he says it does reassure investors, or at least let me put it this way, it scares short sellers.
Is recession still your base case call? I mean, and I understand the difficult
not this year.
Task that he has. Not this year, but ultimately, even if it's in 23. I mean, Ken Griffin this week, Powell's in a very, very difficult position. He said, we're in perhaps the greatest period of uncertainty since the great financial crisis. That from Ken Griffin of Citadel this week. It speaks to the challenge that Jay Powell and company have in front of them.
And I had almost the exact same message that I took away from Paul Tudor Jones, who said almost the same thing. So I think we got a hat trick. I think Jeffrey Gundlach, Paul Tudor Jones, and Ken Griffin are in agreement that this is one of the toughest environments. I mean, here we are. It's better than it was, say, September to December of last year, when the stock market was so overvalued, and you knew that rate hikes had to come because the bond market was so far ahead of the curve, i.e. the Fed was so far behind the curve. And we knew quantitative tightening was coming. That piece of the puzzle was pretty clearly articulated. And that's going to be the one thing that challenges the system as we move forward. We do have double-barreled tightening going on. And while 50 sounds good when you're worried about 75, I heard from that press conference that there's 250s coming back to back. And the bond market pricing definitely corroborates that. The bond market thinks there's 350s coming in the 5 meetings that remain by
for certain.
year-end. So,
but do you make the argument too, though, that the markets have gotten ahead of themselves, bond market included? I mean, if you look at what the markets have factored in, it wouldn't necessarily mesh with what Mr. Powell just said.
The bond market has been displaying the early signs of late cycle activity. The yield curve flattening is a big piece of it. Credit spreads have been widening. Not in an alarming rate that's gotten a lot of attention, but even investment-grade corporate bond yields spreads are out by about almost 50 basis points. They probably narrowed in today. We're in a strange environment, Judge, where when interest rates rise, spread sectors, credit sectors actually widen in yield. That's pretty unusual. It's because we're at such a low rate level and there's so much perceived risk. And now here in 2022, when you get a rally in Treasury bonds, against historical patterns, you get a tightening in spreads. Basically, when the bond market rallies, you're getting more confidence in liquidity. And that's what's been happening. So I expect we're going to see fairly positive returns, even out of the credit sectors in the bond market. I'm not talking about for the rest of the year. I'm talking about in the weeks ahead.
Well, it's interesting. I mean, you referenced Paul Tudor Jones. And to refresh people's memory on what he said also on this network, so much news has happened on this network this week. You don't want to be in bonds or stocks, said PTJ. Can't think of a worse macro environment than where we are now. So it sounds like you agree with the comment about the uncertain environment that we're in, but don't necessarily agree on where you can make some money, at least in the near term. Is that fair?
I think Paul Tudor Jones is a lot more aggressive than I am. And so I think that he's willing to take more extreme positioning. I'll reiterate, I still like the highly diversified portfolio with commodity exposure, which continues to work. I mean, it's incredible how the commodity markets, since we talked in March, are up about 7%. And that's with, for most of that time, a lot of risk assets not doing very well. So I still like a commodity position as much as a third of a portfolio. I like non-U.S. stocks. We've been using Europe. That's been doing well. That's one of the better performing sectors. And I like long-term treasuries only because we still have a recessionary risk and a deflationary risk. So the fact that you're losing money on the treasuries isn't really a reason not to own them. Because if you do this blend of cash, which now should probably only be about 15%, commodities, long-term treasuries, and a variety of stocks, this has been a formula that's worked quite well. It's had a return of about 8% over the past year, and the past year hasn't been very good for a lot of portfolio positioning. And it's actually almost flat year to date, a mix like that, which is what we need. Paul Tudor Jones talked about capital preservation. I agree with that. I think there's various ways of achieving capital preservation. I like this diversified mix. Paul Tudor Jones probably likes, active trading more than I do, but he's more aggressive than I am. So anyway, that's how I see it, Scott.
Good. It is interesting, though. I mean, you have maintained what has been a 25, 25, 25, 25 allocation, for those who are playing at home and trying to figure out how to make their portfolios work the best for them, that being commodity stocks, non-U.S. bonds, and cash, each getting a 25% weighting. But now you're upping commodities to 35 and dumping cash down to 15.
Well, that's actually a move that I made a few months ago. But yeah, the 25, 25, 25, 25 thing is a good starting point. We move around that because, we're on top of it every day, and a lot of investors have another job to do other than just following their own 401k and the like. But yes, I like that diversified mix. The worst performer in that mix has been the long-term treasuries, but it hasn't. But it's served us well during certain periods of market turmoil, and I think it can again.
So if we look at rates, since we're talking a bit about that as well, it's really amazing how far rates have gone, or how much the environment at least seems to have changed since we last spoke on the last Fed day, not that long ago, obviously, in March. The 10-year, and it's hard to remember that it was at this. The 10-year was at 217 when we spoke last. Yeah. Now let's call it 3%. Yeah. The 2-year has moved almost 100 basis points. It was at 193. And then it was at 280, until today, and we had the market move.
That's a really good comment, Scott, because we feel it the same way in our investment meetings at Double Line. You look at where we were in January, and you almost have to be in disbelief that that's how we started the year. The 2-year Treasury is up 200 basis points year to date. That's before the presser today, so it's probably up a little bit less now. The 5-year up 170, the 10-year up 150 year to date, the 30-year up 110 basis points year to date. So the curve broadly has flattened. But yeah, that move up in the 2-year was incredible. It was about 120 basis points over a 5-week period of time. And that's what got the Fed to really get religion about saying we have to stop pretending about this transitory inflation and just identify it for what it is and get moving. And the bond market was relentless in basically taunting the Fed into changing its policies. And it looks like the Fed has now placated the bond market to a certain extent. So again, your comment is excellent. It's hard to believe where rates were just a few months ago and how much they've moved. And like we said in March, I don't care, when the VIX is up a lot, when rates have already gone up a lot, that probably means that an awful lot of things have been factored into the situation. And so the bond market, I think, has found a local high in yields.
And frankly, I mean, you're looking into a camera, so you can't see the picture we're showing now as you're speaking. We're showing the curve, and we're showing where interest rates were. And as I was going back and watching our prior interview to prepare for today, we had the same thing on the screen. And I just marveled at where rates were not that long ago and where they've gone. And let's go back to where we let's bring this full circle for a moment, if we could. And that is this idea of whether Powell can pull this off. And this notion of what you told me the last time, that you thought we were near peak inflation. And then when you were with Pisani down in Miami just a few weeks ago as well, you said, quote, "I think we are near peak inflation." So if you think we are there, and
for.
That's your home. That's where you're from. And you've pledged tens of millions of dollars for an art